Now the topic before us is fractional reserve banking, a simple definition and overview. Fractional reserve banking is a banking system in which commercial banks are required to keep only a fraction, a portion or a percentage of their customers' deposits as reserves and lend out the rest. This is the simple definition of fractional reserve banking. It means that when we deposit some money in the banks keep certain percentage of the same with them, or with or some portion with central bank, and the rest amount and the balance amount is used for lending purposes. The reserve requirement in fractional reserve banking usually includes both cash by the commercial bank and fund kept in the accounts at central bank. Now we will understand the meaning of fractional reserve banking in reality. Suppose you go to the bank and deposit, say, $100 in the bank. The banks are under the supervision of a big bank which is known as central bank. All the banks have to comply with the directions of the central bank, and as per the directives of the central bank, certain percentage of the deposit, each deposit has to be kept aside, which is in the form of cash, or some percentage may be deposited with the central bank. So some portion has to be kept aside. Suppose we assume that reserve ratio as fixed by the central bank is 10%. So here the banks will keep 10% of this initial amount, initial deposit, that is $1,000. 10% means $100 the bank will keep aside as reserves. Then the banks will lend out the balance loans to someone, say another person B, because initial deposit was $1,000, and after keeping 10% reserves, the banks have given loan of $900 to a person B. You also know that usually the banks do not give the money in cash. If you ask for loan, they will not give you hard currency, physical notes or points. They will usually deposit that amount which has been given to you in the shape of loan. They will create a deposit in your name. So the amount is deposited in the name of B. So it becomes deposit. Deposit becomes $900, which was given loan. It has taken the shape of a deposit. So now the bank will again use that deposit to give loan. Here again, the bank will keep aside 10% as reserves. So now the bank will be in a position to advance loan of $810 to another person C. As already told, banks do not give money in cash. So again, this money gets deposited in the same bank in the name of C. So now the banks are again in a position to keep 10% of this $810, and 90% of 810, that is $729, will be given on loan. 2% D. So this process goes on. This is fractional reserve banking. That is, in on the basis of the initial deposit, some reserve is kept aside and the balance is given on loan. This loan takes the shape of deposit, and again, after keeping 10% or the reserve ratio aside, the balance is again given on loan. So this process goes on. It is naturally, this question may naturally arise in your mind that in this way the banks may create lakhs of dollars when the initial deposit is simply $1,000. No, it is not so. We will certainly find a answer to that. How much money can be created by the commercial bank on an initial deposit? We will find an answer to this in the coming videos. So this all is fractional reserve banking. Fractional reserve means keeping a fraction the initial deposits as reserves and then lend out the balance and again redepositing and again giving loans. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.